The financial weapons that crashed the world: CDOs, mortgage-backed securities, and credit default swaps. For most people, the 2008 financial crisis began with collapsing banks, plunging stock markets, and millions of lost jobs. But the real story started years earlier, inside the world's largest financial institutions, hidden behind walls of mathematics, legal contracts, and Wall Street jargon, were three financial inventions that transformed ordinary home loans into a global web of risk. They were mortgage-backed securities, collateralized debt obligations, and credit default swaps. On the surface, each of these products appeared to solve a problem. Banks could issue more mortgages without running out of money. Investors could earn higher returns than government bonds. Insurance-like contracts could supposedly eliminate risk altogether. Financial engineers claimed they had discovered a new system that spread risk so widely that the entire financial system would become safer. It sounded like the perfect machine. Instead, that machine became one of the most destructive financial mechanisms ever created. When American homeowners began missing mortgage payments, the damage didn't remain in one neighborhood or one state. It traveled through investment banks in New York, insurance giants in London, pension funds in Europe, and sovereign wealth funds in Asia, as well, and eventually into nearly every major economy on earth. What began as a housing downturn evolved into the worst financial crisis since the Great Depression. To understand how that happened, we need to follow the money from an ordinary family buying a home to all the way. To understand how that happened, we need to follow the money from an ordinary family buying a home all the way to the complex financial instrument that multiplied billions of dollars in mortgages into trillions of dollars of interconnected financial exposure. In this video, we will dismantle these financial products layer by layer and explain how Wall Street turned debt into one of the most profitable and ultimately catastrophic business models in modern history. From a simple home loan to a global investment. Everything began with something remarkably ordinary: a mortgage. Imagine a young couple buying their first home for $300,000. They approached a local bank, made a down payment, and borrowed the remaining money. Every month, they sent the bank a mortgage payment consisting of interest and a small portion of the principal. For decades, this is how banking worked. The bank issued the loan, collected payments for 30 years, and earned profit from interest. This traditional model imposed a natural limit on lending. Every mortgage remained on the bank's balance sheet. Tying up capital for decades. If a bank had enough deposits to finance 1,000 mortgages, it could lend only that much. Growth was slow, predictable, and constrained by available funds. Then Wall Street introduced a new idea known as securitization. Instead of keeping mortgages until they were repaid, banks could sell them almost immediately after issuing them. Investment banks purchased thousands of mortgages from lenders across the country, bundled them together into massive pools, and transformed those pools into tradable financial securities known as mortgage-backed securities, or MBS. The logic appeared brilliant. Instead of relying on one homeowner's monthly investor in the logic appeared brilliant. Instead of relying on one homeowner's monthly payment, an investor now owned a tiny share of thousands of mortgages spread across different cities and states. If a few borrowers defaulted, the remaining thousands would continue making payments. Diversification seemed to reduce risk while still generating a steady stream of income. For banks, the advantages were enormous. Selling mortgages meant recovering their money almost immediately, allowing them to issue even more loans. Instead of waiting 30 years to recover their capital, they could recycle it within weeks. Mortgage lending exploded because now every loan could quickly be sold into the growing market for mortgage-backed securities. Investors also rushed in. Pension funds, insurance companies, mutual funds, university endowments, and foreign governments all wanted these securities. Compared with government bonds, mortgage-backed securities often offered higher interest while still carrying impressive credit ratings. They appeared to deliver the ideal combination of safety and yield. As demand increased, Wall Street needed an endless supply of new mortgages to package and sell. This changed the incentive across the entire financial system. Banks were no longer primarily concerned with whether borrowers could repay their loans over the next 30 years. Their main priority became originating as many mortgages as possible because the loans would soon be someone else's responsibility. The traditional relationship between lender and borrower began to disappear, replaced by an assembly line designed to produce mortgages for global investors. That shift in incentives laid the foundation for everything that followed. The birth of subprime mortgage machine. As investors' demand for mortgage-backed securities continued to surge, Wall Street encountered a fundamental problem. There were not enough qualified borrowers to produce the volume of mortgages investors wanted to buy. Prime borrowers, people with stable incomes, strong credit histories, and reliable payment records, represented a finite market. To keep to keep the securitization machine running, the industry needed more loans, regardless of who received them. Lenders responded by lowering their standards. Mortgages were increasingly offered to borrowers with weak credit histories, unstable employment, high existing debt, or limited documentation of income. These became known as subprime mortgages. Many borrowers who would have been rejected only a few years earlier were suddenly approved with little scrutiny. The lending practices grew progressively more aggressive. Some mortgages required no proof of income, no verification of employment, and minimal documentation of assets. This became infamous as ninja loans: no income, no job, no assets. Adjustable rate mortgages offered low introductory payments that would reset to much higher interest after a few years. Many borrowers qualified only because of those temporary low payments, not because they could afford the long-term cost of the loan. Why would lenders knowingly approve risky borrowers? The answer lay in the changed incentives. Since the mortgages were destined to be sold into mortgage-backed securities almost immediately, the originating bank often bore little long-term risk. The lender earned fees for creating the loan, the investment bank earned fees for packaging it, the credit rating agency earned fees for evaluating it, and brokers earned commissions for bringing in new borrowers. Every participant profited at the moment the mortgage was created, not over the decades required for repayment. This created a classic moral hazard. The institutions making lending decisions were increasingly insulated from the consequences if those decisions proved unsound. As long as housing prices continued to rise, borrowers who encountered financial difficulty could refinance or sell their homes. Rising property values concealed weaknesses that would otherwise have been obvious. By the mid-2000s, the housing market had become a self-reinforcing cycle. Easy credit increased demand for homes, rising demand pushed homes prices higher, and higher prices convinced both lenders and borrowers that real estate was a safe investment. The apparent success of the system encouraged even riskier lending, because every year of rising prices seemed to validate the assumption that housing values would continue climbing indefinitely. Yet beneath the surface, the quality of the underlying mortgages was steadily declining. The mortgage-backed securities being sold around the world increasingly depended on borrowers with fragile finances, loans designed to become more expensive over time. The foundation of the entire financial structure was becoming weaker, even as the market celebrated record profits and soaring home prices. That hidden deterioration would soon expose the next. Not even complex financial intervention, the collateralized debt obligations, CDOs, turning risk into an illusion of safety. By the middle of the housing boom, Wall Street faced another challenge. Even after packaging millions of mortgages into mortgage-backed securities, there was still enormous investor demand for highly rated investments. The supply of safe assets were running out, but the appetite for them kept growing. Instead of slowing down, financial engineers invented another product that appeared to create more safe investments out of existing risky ones. That product was the Collateralized Debt Obligation, or CDO. To understand a CDO, imagine that hundreds of mortgage-backed securities already exist. Each contains thousands of home loans. Some of these mortgage securities are considered high quality, while others contain large number of risky subprime mortgages. Investment banks gathered pieces of these securities together, mixed them into a new financial pool, and issued a completely new set of securities backed by the pool. It was debt built on top of another debt. The cash flowing into a CDO was divided into layers called tranches. At the top sat the senior tranche, which received mortgage payment first and was considered the safest. Below it came the mezzanine tranche, which accepted more risk in exchange for higher returns. At the bottom sat the equity tranche, which absorbed losses first but promised the highest potential profits if everything performed well. Supporters argued that this structure made the senior tranches exceptionally secure. Their reasoning was that even if many borrowers defaulted, the equity and mezzanine tranches would absorb these losses before the senior investors suffered any damage. Mathematical models suggested that defaults across thousands of home owners in different regions were unlikely to occur simultaneously. Based on those assumptions, many senior CDO tranches received the coveted AAA credit rating, the same rating often assigned to government debt. This process created a remarkable illusion. Many of the mortgages entering these CDOs were individually risky. Yet, after being sliced, rearranged, and redistributed, large portions of the resulting securities were labeled as some of the safest investments in the world. Risk had not disappeared, it had merely been reorganized and described differently. The demand for these highly rated CDO became enormous. Banks, insurance companies, pension funds, hedge funds, foreign investors purchased them believing they offered higher returns with minimal additional risk. Every new CDO encouraged the creation of even more mortgages, including risky subprime loans. Because Wall Street now had another profitable product to manufacture and sell, the financial system had become several layers removed from original homeowners. A single mortgage payment might flow into mortgage-backed security and then into a CDO before eventually reaching investors scattered across the globe. With every additional layer, understanding the true source of the underlying risk became more difficult. Complexity itself became a selling point, obscuring weaknesses that were accumulating beneath the surface. The next innovation would magnify those risks even further by allowing institutions to bet on mortgage failures without owning a single mortgage. That innovation was credit default swap. Credit default swap, betting on collapse. If mortgage-backed securities and CTOs spread mortgages risk throughout the financial system, credit default swaps transformed that risk into a global betting market. They were originally designed as a form of financial insurance, but over time, they evolved into something far larger and far more dangerous. A credit default swap, or CDS, is essentially a contract between two parties. One party owns a bond or a CDO and wants protection in case of defaults. The other party agrees to provide that protection in exchange for a regular premium payment. If the underlying investment performs normally, the seller simply collects those premiums. If the investment fails, the seller must compensate the buyer for the losses. On paper, the arrangement appeared sensible. An investor holding $1 billion in mortgage-backed securities could purchase credit default swaps to reduce the risk of catastrophic losses. Just as homeowners buy fire insurance for their houses, investors could buy default insurance for their financial assets. The critical difference was that credit default swaps didn't operate like traditional insurance. You didn't need to own the underlying mortgage security to buy a CDS. Anyone could purchase protection on a bond or CDO they never possessed. That meant investors could speculate on the failure of mortgage securities in exactly the same way traders speculate on the price of oil or gold. Imagine a single $100 million CDO. In a traditional insurance market, there would normally be only one insurance policy covering that asset. In the CDS market, dozens of institutions could independently purchase swaps referencing the same $100 million CDO. Suddenly, a financial product worth $100 million could generate several billion dollars of insurance-like contracts. The amount of money at risk became many times larger than the value of underlying mortgages. This dramatically increased leverage throughout the financial system. Institutions that sold credit default swaps collected steady premiums and believed widespread defaults were extremely unlikely. As housing prices continued to rise, these contracts seemed almost risk-free. Selling CDS became a highly profitable business, and firms accumulated enormous exposure without maintaining sufficient capital to cover a nationwide collapse in housing. One of the largest sellers was the insurance giant AIG. Though its financial products division, the Though its financial products division, the company sold hundreds of billions of dollars in credit default swaps linked to mortgage securities because executives believed AAA rated CDOs were exceptionally safe. They collected premiums while setting aside relatively little money for potential payouts. This strategy generated impressive profits for years, but it rested on a single assumption that the housing market would never experience a broad, sustained decline. By the middle of the 2000s, the financial system had become an intricate web of mortgages. Mortgage-backed securities, CDOs, credit default swaps, every institution believed it had transferred risks to someone else. In reality, the same underlying mortgage defaults had been multiplied, repackaged, and redistributed so many times that no one fully understood where the ultimate losses would fall. When American homeowners finally began missing their mortgages payments in large numbers, that hidden web would unravel with extraordinary speed. When the dominoes began to fall, the entire financial system depended on one assumption that almost nobody questioned: American housing prices would continue rising. Even if a borrower struggled to make mortgage payments, the house itself was expected to become more valuable over time. Rising prices allowed homeowners to refinance, sell at a profit, or borrow against their growing equity. As long as that cycle continued, the weaknesses embedded in millions of risky mortgages remained hidden. The first cracks appeared in 2006. Housing prices stopped climbing at their previous pace and began to decline in many regions. Adjustable rate mortgages that had offered low introductory payments started resetting to much higher interest rates. Thousands of borrowers suddenly found themselves facing monthly payments they could no longer afford. Delinquencies increased, followed by foreclosure. For an individual bank, a wave of defaults would have been manageable if the problem had remained localized. But these mortgages had already been sold into mortgage-backed securities, repackaged into CDOs, referenced by countless credit default swaps. Every missed mortgage payment reduced the cash flowing into securities held by investors around the world. The market quickly lost confidence in the value of mortgage-backed securities. Investors could no longer determine which securities contained relatively safe mortgages and which were filled with falling subprime loans. Prices fell sharply as those securities lost value. The CDOs built on top of them suffered even larger losses because they were already one step removed from the underlying assets. Credit rating agencies reacted by downgrading thousands of securities that had previously carried AAA ratings. Assets that many institutions had considered nearly as safe as government bonds were suddenly classified as highly risky. Investors who relied on those ratings were forced to recognize enormous losses on their balance sheets. The crisis then entered its most dangerous phase. Institutions that had sold credit default swaps were required to compensate buyers as mortgage securities defaulted. These obligations reached tens of billions of dollars. Firms that had collected premiums for years suddenly faced claims far exceeding the capital they had available. At the same time, banks became increasingly uncertain about the financial health of their counterparties. If one institution failed, every firm connected to it through loans, derivatives, and swap contracts could suffer major losses. Trust, the foundation of modern banking, began to disappear. Banks became reluctant to lend, even to one another, because they could not determine who was holding the largest exposure to toxic mortgage assets. Credit markets froze, businesses struggled to obtain financing, and liquidity throughout the global financial system began to evaporate. What had started as rising mortgage defaults among American homeowners had evolved into a systematic crisis. The complex financial products that were designed to distribute risk had instead transmitted it across the entire world. The stage was now set for the collapse of some of the world's largest financial institutions in history, culminating in the bankruptcy of Lehman Brothers and a global financial panic unlike anything seen in generations. Lehman Brothers, AIG, and the global financial meltdown. By September 2008, the crisis had reached a breaking point. For more than a year, governments and central banks had attempted to stabilize financial markets through emergency lending, liquidity injections, and rescue operations. But confidence continued to erode as the losses mounted across the banking sector. The world was about to discover that some institutions were simply too interconnected to fail without threatening the entire global economy. One of the first major casualties were Bear Stearns. Once one of Wall Street's most respectable investment banks, it suffered a collapse in confidence after investors realized the extent of its exposure to mortgage-related assets. As clients and trading partners withdrew, Bear Stearns faced a liquidity crisis and was sold to JP Morgan Chase in a government-supported emergency transaction. The rescue temporarily calmed markets, but it didn't solve the underlying problem. Attention soon shifted to Lehman Brothers. The firm had accumulated enormous positions in mortgage-backed securities and the other real estate investments financed with borrowed money. As the value of those assets declined, Lehman's balance sheet quickly weakened rapidly. Potential buyers hesitated, fearing hidden losses that were impossible to measure accurately. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. Financial markets reacted immediately. Investors realized that if a major Wall Street institution could be allowed to fail, no financial firm could automatically expect government support. Panic spread across global markets. The consequences extended far beyond Lehman itself. Banks, investment funds, and corporations around the world had financial relationships with the firm. Many didn't know whether their contracts would be honored or whether they would recover their money. Interbank lending nearly stopped as institutions chose to preserve cash rather than lend to counterparties. Those financial conditions were uncertain. Only one day later, another giant stood on the edge of collapse. American International Group, or AIG, had sold hundreds of billions of dollars in credit default swaps protecting mortgage securities, or CDOs. As those securities deteriorated, AIG was required to provide collateral and prepare for massive payouts. The company didn't have sufficient liquidity to meet its obligations. Unlike Lehman Brothers, AIG was rescued. The US government concluded that allowing the world's largest insurer to fail could trigger an even greater financial catastrophe because so many banks depended on AIG's ability to honor its swap contracts. The Federal Reserve extended emergency financing that eventually exceeded $180 billion, effectively nationalizing the company to prevent a complete collapse of the financial system. The panic rapidly crossed borders. European banks revealed large holdings of American mortgage securities. Asian financial markets experienced severe volatility. International trade slowed as banks became reluctant to issue trade financing. Businesses delayed investments, consumers reduced spending, and companies began laying off workers. What had begun as a crisis in the American housing market had become a synchronized global recession affecting nearly every major economy. The crisis demonstrated that financial innovation does not eliminate risk. Mortgages had been transformed into securities, securities into CDOs, and CDOs into trillions of dollars of credit default swaps. Each layer increased complexity and interconnectedness. Instead of dispersing risk safely, the system had concentrated it in ways that became visible only after the housing market turned downward. When confidence disappeared, the entire structure unraveled with astonishing speed. The lessons of 2008 and why the world still watches these markets. The global financial crisis permanently changed the way governments, regulators, and investors viewed modern finance. The collapse demonstrated that sophisticated financial engineering cannot eliminate risk. It can only redistribute it, disguise it, or in some cases amplify it. The mathematics behind mortgage-backed securities, CDOs, and credit default swaps were not inherently flawed. The danger rose from unrealistic assumptions, poor incentives, excessive leverage, and a widespread belief that housing prices could only move in one direction. In the years that followed, governments introduced sweeping reforms. Banks were required to hold larger capital reserves, meaning they had to maintain more money to absorb future losses. Stress tests became routine, forcing major financial institutions to demonstrate that they could survive severe economic downturns. Derivatives such as credit default swaps increasingly moved towards centralized clearing systems, making exposures more transparent and reducing counterparty risk. Mortgage underwriting standards also became stricter, limiting many of the lending practices that had fueled the housing bubble. Credit rating agencies faced intense criticism for assigning top ratings to securities that later suffered catastrophic losses. Investors also became less willing to rely solely on ratings, placed greater assumptions on their own due diligence. Regulators recognized that risks hidden in complex financial products could threaten the stability of the entire economy rather than individual institutions. Despite these reforms, the fundamental concept behind these instruments didn't disappear. Mortgage-backed securities remain an important source of housing finance in many countries. Collateralized debt structures continue to exist, although they were generally backed by a wider range of assets and subject to tighter oversight. Credit default swaps were actively traded and remain. Credit default swaps were still actively traded and remain valuable tools for hedging credit risk when used prudently. The broader lesson extends far beyond mortgages. Every financial boom tends to create a narrative explaining why traditional rules no longer apply. During the early 2000s, that narrative centered on permanently rising housing prices and sophisticated financial engineering. Similar narratives have appeared throughout history, from the dot-com bubble to cryptocurrency speculation and other periods of rapid asset appreciation. Markets evolved, technologies changed, and financial products became more sophisticated, but the underlying forces of leverage, speculation, incentive misalignment, and human optimism remained remarkably consistent. Understanding the mortgage-backed securities, CDOs, and credit default swaps is therefore not simply an exercise in financial history. These instruments illustrate how ordinary economic activity can become embedded in a vast, global financial network where decisions made by homeowners, lenders, investors, bankers, insurers, regulators, and investors influence one another. The events of 2008 remain one of the clearest demonstrations that when complexity outpaces transparency and incentives reward short-term gains over long-term stability, local problems can rapidly become global crises. Conclusion: the story of the 2008 financial crisis was not the story of a single bad investment or one irresponsible bank. It was the story of an entire financial system that gradually abandoned the principle of understanding risk in favor of maximizing short-term profit. Every participant believed someone else was carrying the danger. Banks believed they had transferred it to investors. Investors believed diversification had eliminated it. Rating agencies believed statistical models justified their highest ratings. Insurance companies believed that nationwide mortgage defaults were virtually impossible. In reality, everyone remained connected to the same underlying mortgage. Mortgage-backed securities allowed banks to transform home loans into tradable investments. Collateralized debt obligations repackaged those investments into even more complex products that appeared safer than they actually were. Credit default swaps created a massive network of financial bets that multiplied the consequences of every mortgage default. Individually, each innovation served a purpose. Combined, they produced a system whose complexity concealed its fragility. When American homeowners began missing mortgage payments, the effects spread through every layer of that system. Securities lost value, CDOs unraveled, credit default swaps triggered enormous obligations, major banks collapsed, insurance companies required government rescues, and global credit market froze. Businesses could no longer borrow, customers cut spending, unemployment surged, and economies around the world entered recession. The crisis remains one of the most defining economic events of the 21st century because it exposed a timeless truth. Financial markets can create extraordinary wealth, but it cannot repeal the laws of economics. Debt must ultimately be repaid. Risk cannot be destroyed through clever engineering. Leverage magnifies both profits and losses, and when incentives reward volume over quality, complexity over transparency, and confidence over caution, the cost eventually extends far beyond Wall Street to households, workers, and governments across the globe. Understanding this instrument is therefore more than understanding financial terminology. It is understanding how modern finance channels capital, how incentives shape behavior, and how interconnected markets can transform local decisions into global consequences. The next financial crisis will almost certainly involve different assets and different technologies, but the underlying lessons of 2008 remain as relevant today as they were when the first cracks appeared in the American housing market.